If you've been someone who has been fortunate and actually done what you should, which is saved really well for retirement, the government's not pleased with you in this bill. Uncle Sam is at it again, sticking his hands down in your pocket and stealing a little bit more of your wealth. We've been seeing talks about higher tax rates this year. We've been talking about this a lot with clients. And finally, we have some more information that's come through the House Ways and Means committees with a recent release last week, an 800-page document of all sorts of new ways for them to get access to your hard-earned money. We want to talk today about some of the high-level items that executives should be looking at in this bill. Nothing is finalized yet. It still has to go through the Senate. But this is some of the information that really gives us a better idea of where they're trying to go and some more concrete numbers to work around. One item that you're going to hear a little bit about on the news is a new highest income tax rate. This would be subject to your regular income taxes. Currently, the highest federal income tax rate is 37%, and they want to take that number up to 39.6%. The wild thing about that piece of information is that people in New York, their highest rate between state and federal would bring them up over 61%. I would argue that's definitely more than their fair share, but over in California, they get their fair share as well. Between federal and state, highest income rates would be upwards of 59%. So that just shows that we need to do what we can to be hedging these risks and dealing with this not just through management of your portfolios, but even through your work and compensation structure and benefits. There are ways to deal with these and try to lower that tax bill. Another item that you'll probably hear about is long-term capital gains rates. There was a lot of discussion all throughout the year. Currently, the highest federal long-term capital gain rate sits at 20%. And there's been talk through the Biden administration that they wanted to take that upwards of 39%. We've been talking to clients and we didn't think the number would go that high. We believed that it would get negotiated down a fair amount. And in this, it shows that that number was looking like 25%. Now, to go from 20 to 25%, we think is still a substantial increase. And again, it shows the importance of doing all of this planning even now within your portfolio and your work benefits and stock compensation to make sure that you're really tax efficient so that you don't lose a quarter of what you've worked for and that you've already paid taxes on. Now, there was a sneaky piece of information inside the bill that they did in relation to long-term capital gains. The government knows that many people will watch this document and then they'll look to move and potentially sell positions ahead of capital gain rates going up next year. So to hedge that off, they made the new capital gain rate, whatever it lands at, potentially effective as of the date that the document was released, which was September 13th. So any sales occurring after that would be subject to the new higher capital gain rate, which is a pretty sneaky little move by them. The thing that I look at in there is the importance of doing what we do, which is hedging taxes all throughout the year and not waiting until the end of the year. A lot of individual investors and honestly even advisors and brokers wait until the end of the year to try to do some tax harvesting and things like that. For us, that's just not nearly good enough for what clients need, and you should do more, which is proactive hedging all throughout the year. So this bill really proves the importance of that. Additionally, there's a few more things that really tie into retirement planning. And if you've been someone who has been fortunate and actually done what you should, which is saved really well for retirement, the government's not pleased with you in this bill. So anyone with a very large, what they would call a very large IRA, is going to be a little bit under fire on this bill. So balances over $10 million, the government's going to go after, and they're going to be looking to get distributions out of those holdings through work and individual retirement accounts to make sure that the balances essentially never exceed that $10 million balance. So the way that they'll do that is if the balance is over $20 million, they want to force a full distribution to bring it down to $20 million number. If it's still over 10 million, what they want to do is force a 50% distribution of that balance over 10. And then also, if you have substantial income and a substantial balance as well, limit your ability to contribute to those plans. So they're really going after these large balances and going after the people who use the programs the way that they should, because they're viewing those really as an unfair tax shelter when they get to that size. Additionally, another item is that they want to go after high earners that do backdoor Roth conversions. It's a common strategy which allows you to still make contributions to a Roth IRA even if you normally wouldn't be allowed to due to your income. And what they're saying is that if your marital household income is over $450,000, that you no longer can utilize that strategy. It sounds like they might even be limiting Roth conversions in general. So again, they want to penalize you for doing high quality planning and doing what you should, which is working within the rules of the system and being successful at that. So the big thing to take away here is there's still a lot of other tools that you can be utilizing. For instance, on the Roth conversion front, there are strategies that we utilize within employer plans that sometimes honestly are even much more powerful than normal Roth conversions that people do. So there's ways that you need to be evaluating and researching these options so that you can still protect and hedge these substantial taxes, because between taxes and inflation, those are two of the biggest risks to your wealth, and you need to make sure that you're doing everything that you can to protect it. If you have any questions, if you'd like to talk to a member of our team about how you should be handling these things going forward, we have a couple of really great programs to consider there. But absolutely reach out to a member of our team. We'd enjoy the opportunity to talk to you, and we hope you have a wonderful day. Thanks.